Hello and welcome to Pensions Awareness Week 2022, and this is our SME Masterclass in Pensions and Benefits for Business Leaders. Thank you for joining us this morning. My name is Olive Ryan and I'm Head of Client Services at Moneycube.ie, and I'm joined today by Alan Deneen from Zurich Life Assurance. Hi Alan.
Hi Olive, great to be here, thank you.
Thank you for being here. So today we're going to try and cover three topics that will benefit companies and small business owners. One will be about maximising tax efficiencies for your business. Secondly, we're going to try and cover some of the regulatory changes that have occurred in the last 12 months that will impact how those tax efficiencies are accessed, and also some of the changes that are coming down the line when it comes to company pensions. And also finally then we're going to try and capture some of the other benefits that companies should be thinking about to protect their business, to protect the people, the key people in those business and themselves as well. So hopefully somebody listening to this who's a small business owner or a director of an organisation will get some key tips on what they should be thinking about right now.
Yeah, absolutely, absolutely.
Okay, brilliant. We'll kick off, Alan, talking about the tax efficiencies. So for company directors, small business owners, sole traders, this is kind of a key time of year really, isn't it? We'd normally be talking to people about what to do to increase pensions, make a pension contribution generally, to reduce that tax bill as they're totting up their end of year tax bill right now with their accountants.
Yeah, absolutely. I suppose if you look at some of the kind of small business owners, if they're running a limited company or if they're indeed a kind of a sole trader, like the end of the year is generally seen as the time, like you said, to do the accounts, to get the taxes in order, to sit down with the accountant and go through everything that's happened, which hopefully they've had a busy year, that they might have some funds left over to be able to look at the pension type of stuff. Traditionally, a lot of sole traders in the end of October would be your tax return time with the revenue. That can kind of move into the middle of November for people who file their taxes online. But it's really now kind of leading in over the next number of weeks. Sit down with your financial advisor, sit down with your accountant, and really have a look and assess where you are as part of the plan, kind of going forward. But I suppose it can depend on whether you're a limited company owner versus if you're a sole trader, which kind of avenue is the best for you to look at. So there's still, as much as we're trying to simplify everything over the last few years, there's still a lot to sit down and talk about on a year-on-year basis.
Yeah, and coming back to that point, if you're a sole trader, there are kind of two main options. There's the personal pension, where you own the pension and you make the contribution.
Yep.
The personal retirement savings account is a PRSA for short.
Yep.
That's similar, but the PRSA also overlaps for people who are not sole traders, who are in limited companies. And the limited company side of things, there has been a few changes this year for people in limited companies and how they access pensions.
Yeah, exactly. So you've hit the nail on the head there in terms of, if you're a sole trader with your personal pension, and then if you go to the other side of things, you have the limited company. So you would have heard phrases like executive pension, company pension, director's pension. It's been known as a few different kind of umbrellas over the years. And in the middle, then you have the PRSA, which can be used if you're a sole trader or if you're in the limited company side of things. But what's happened with the one over here for the limited company and the company directors over the last couple of months, and there's been a lot of legislative change in Europe in terms of this regulation called the IORPS legislation. Yeah. And what they're effectively trying to do in a nutshell is reduce the amount of trustees that are having the oversight on pension schemes. And Ireland traditionally had been seen to have a high number of those trustees. Okay, so what has happened over the last few years is then the local regulators have to kind of interpret the European legislation. And what the local regulators have done is they've pulled back a little bit on the allowances of the executive pension or the company director's pension. So at this moment in time, as we're talking, we're hoping to have a resolution to that kind of across the financial planning industry between the different companies involved. But at the moment, we're not just quite there just yet. Now, we're hoping kind of towards the back end of the year that there will be a change on it. But you then have, I suppose, a lot of company directors who were, planning over the last couple of years. And if they're in an executive pension arrangement up to now, depending on when they got into it, they may be fine to keep on funding for the next few years. Yeah. But some people may have, put it on the long finger and said, I'll do it in 2022 or I'll do it in 2023. They're kind of a little bit hampered at the moment in terms of what they're able to do, So watch this space. Watch
this space. But in the meantime, I mean, we, like you say, there's the industry are trying to, so essentially that executive pension, as we would have called it, is off the table as a new option for people. If you have one already, great, you can keep contributing to it and you can make your lump sum contribution into that if you need to top up. But if you didn't have one in place, you can't create one now. But there are options, and like the industry is trying to put something in place to replicate or to replace it in another type of pension arrangement that will allow for those, that's the same opportunity that company directors had before for that. But it might not be there in time for this year's tax return. So in place of that, options are that PRSA is certainly an option that will probably feature a lot for people because it allows for both the limited company or the sole trader or the employee even can use a PRSA. So it is the most flexible pension option out there for anyone.
Absolutely.
The alternatives, again, are an occupational pension plan. If you had enough members in your company, staff members to join, there is a limit, a minimum amount. But
it depends.
Most companies can facilitate something for
Exactly, yeah. So I suppose people are trying to, make some slight changes to the individual arrangement. But like you said, if you have, kind of 5-10 staff or maybe a little bit more and you're looking to bring on board a company scheme, or if you indeed have a company scheme, the funding limits that you're allowed to put into those type of structures versus the individual, personal pension or the PRSA and stuff, they're very, very different. So again, it's just recommended you sit down and kind of take stock of what those numbers are. But for, I suppose, again, you hit the nail on the head. If people want to make a decision to do something right now at this moment in time, the executive/director's pension or company pension is kind of closed off for them on an individual basis. So they may have to use a PRSA between now and the end of the year, maybe review it again in January. Hopefully the landscape will have changed a little bit and the flexibility will have come back into it,
So like, even though that there's a big legislative change, which is like driving the industry at the moment crazy because they're all scrambling trying to find a solution, there still is an option. Like, it's not going to prevent company directors or business owners from making pension contributions this year like they would normally do.
No, absolutely not. Absolutely not. So,
so just talk to your financial advisor.
Yeah, again, I suppose, look, there's a lot of people at play between, the companies, the regulators and stuff like that. Everybody's trying to come to a simplified solution, but we're in that kind of middle phase where we're trying to get it simplified, and it's actually made it a little bit more complicated. So again, advice is just really important,
Yeah, exactly. And you touched as well on the point that if you did already have a pension, one of those executive pensions, where you were able to maximize the amount that you could fund into those pensions, because essentially there's a difference between an individual putting contributions into their pension and the company putting contributions into a pension for you. And generally the company contribution can be a lot higher than what an individual can do themselves. So if you had that executive pension option or an occupational pension where you can increase the employer contribution at this time of year when you're trying to extract wealth from your business or maximize tax efficiencies, you would urge people, I think we're kind of hearing that max funding could also change in the future. It's been threatened a little bit.
Yeah, it's been in different news articles and different kind of industry bodies and industry people have spoken about the fact that if you're a sole trader versus having a limited company arrangement, that there's a massive disparity in terms of what each individual could fund. So one person here could be able to put €15,000 a year in their pension as an example, but somebody else might be able to put 50, and they're both small business owners who are trying to build pension pots for themselves for when they retire. So then people said, do we just bring everything back down to one level, which means that maybe the company director or the small business owner may actually, have a plan in place to put 20, 30, 40, 50,000 a year in for the next 10 years to build a pot at retirement. That could all of a sudden be changed, and it might only be 10 or 15,000 years they could put in. So all of a sudden your plan is completely changed. But I heard a good phrase recently enough where it says the planning trumps the plan. So you might have made a plan 5 years ago, but as you sit down with your advisor each year and have a chat about different things, you just have to take stock with everything that's happened. So again, trying to say to people, look, the reliefs are there if you're already in one, so make use of them as you can, because all of a sudden with a stroke of a pen, it could be removed, and all of a sudden you have to change your journey and how you're going to plan.
And don't wait for the finance bill to come out to tell us how we deal with these things. Just start considering now what you plan to do. Well, just very briefly, there is a couple of other reliefs to maximise tax efficiencies from your business. If you are thinking or coming close to retirement, or you're thinking about retiring and maybe even passing on your business to someone, there are some reliefs there to capture as well. There's entrepreneur relief and there's retirement relief, and it depends on what age you are and who you're passing your business on to.
Yeah, exactly. So in terms of, a lot of people, especially when they build a business from the ground up, they could be in their mid-50s, have built the business up to a point, and they're in the midst of their business, running their business and day-to-day stuff. Sometimes the element of longevity planning of, do I have a family member to come in to take over the business? Will a business partner, maybe a younger business partner, take it over and buy out a different business member and stuff like that? But it's very important you take stock of the fact of the age you're going to retire and who you're going to pass the business on to, because capital gains tax in this country is like 33% at the moment, okay? So there's certain reliefs out there where you might be able to, pass on a big chunk of your business or at retirement and only have paid a tax of 10% on it, or if it's passed down to family members. Again, there's loads of different reliefs, but you could be, 64 doing something now, and then you could be 67, and two people treated very, very differently in terms of how they're taxed by the Irish revenue. So it's very important to have the 5-10-year plan in place in terms of availing those reliefs, the entrepreneurial relief and the retirement relief.
And that's a key thing, isn't it? And the age is key when it comes to retirement relief. So if you are thinking about it, talk to a tax advisor and get some information about what you are eligible for and plan towards that. Because,
correct. Exactly.
The key point here is that you need to talk to a financial advisor about funding now for to extract wealth from your business and maximise tax, about funding a pension. And if you're planning any changes or selling off your business, and you don't have to retire from a business if you're to gain some of these reliefs, you could sell part of your business and continue to work for it. So it could be a really viable way for you to extract the wealth out of that business that you've built up over the.
And some people might still be enjoying working in their business and say, I'm fit and healthy, I'm 67, I want to work on for another 4, 5, 6 years. But again, they just need to take stock of what that it's great that they can work on their business and they're still feeling good and as enthusiastic about a business as they were 20 years ago, but they may be kind of giving themselves a disadvantage from a tax point of view by not looking at the reliefs up to that time. So kind of the window between 55 and 65, 55 and 60 really aiming towards 65 in terms of what way you're going to structure your business. Does a family member take it over, or are you selling to a competitor or whatever it may be, depending on the industry or kind of the jobs that are in.
If you're in your 50s, and you maybe should start looking at this now, and start talking to some advisor to see how you should start organising yourself first. Brilliant. We touched on the regulatory changes about how you can access a pension if you're a company owner, and there are more regulatory changes coming down the line in the form of auto-enrolment, which will be a word, it'll be in the forefront of our minds for in the near future. But for right now, I suppose it's been touched on. The proposal was released earlier this year. How it'll look. It's proposed to come in next year. It will be a pension scheme that everyone will be automatically enrolled into. So everyone across all employment sectors in Ireland will be participating in this. There are some kind of rules around it.
Certain restrictions. So it's kind of aimed at people who are over 23 years of age and earning more than 20,000 euros per annum. But I suppose a big driver behind all of this is if you kind of look at the state pension and stuff like that in Ireland at the moment, we currently have somewhere between 5 and 6 people working for, paying PRSI into the state pension pot for every one person that's retired. By the time we get to 2050, I think is the year, with the way the demographics are going with age in the country, you're going to have 2 people working for every one person retirement. So people have had enough foresight to know that, right, this financially is going to be a problem down the road, and we need to kind of, help people and incentivize people in terms of tax reliefs, in terms of employers paying into different pots of money for people to, get something private set up in the background at the moment. But it's been aimed for 2023. I suppose we haven't seen exact dates of how that's going to come about, but the key numbers are over 23 years of age, earning more than 20,000 per annum, and you're going to start off with 1.5% of your salary as contribution from the member. That'll be also matched by 1.5% contribution from the employer, and then there's an extra 0.5% of a top-up of kind of a tax relief from the revenue on top of that as well. So again, that will lead up over time, that once you get up to like 5-10 years time, that'll be up around 6% and 6% and stuff like that. So it's designed to get people in on a gradual level, but get the focus up and running.
Kind of to help both employers and employees who are not used to making these contributions already, try and get them in gently and build it up.
Exactly.
But it is going to come, I suppose, it's a great incentive. It's great for employees, and it is, obviously, there's positives for employers as well. It will be something that employers need to be ready for, though.
Yeah.
Like, we don't know that it's going to come in next year. That's the proposal. Right now, I don't know if we could see it happening.
Yeah,
like, there's a lot to do to get it there.
Big time.
But it's coming. Like, we can't ignore it. It is coming.
Yeah.
So employers should really get themselves ready for it. Maybe to start something now before, while you don't wait for it, I suppose.
Yeah, so I suppose there's pluses and minuses of it from an employer's perspective, right? Obviously, look, small to medium-sized business owners, costs are everything at the moment, right? We hear everything about the cost of living, even on a personal level, but businesses are obviously find it, difficult with energy rates and price and stuff like that. So some business owners may see this as an extra outgoing, right, and not see the benefit of it. But what we've seen is with the idea of auto-enrolment coming in, which is kind of a centralized system, a lot of employers, if they have the affordability to do so, are starting something gradual themselves now in advance of the auto-enrolment, okay? But I suppose some of them have underestimated the kind of kudos they're getting from their employees on the back of that, because all of a sudden it's not seen as something that they had to do as an employer. It's seen as, we're bringing this to you, benefits, be it your pension scheme or any other benefits to go with it. We're bringing it to you early in advance of this auto-enrolment coming down the tracks. Depending, again, like you said, what year or month is it coming down the tracks? But like that does help in one thing, which is something that a lot of employers are facing as an issue at the moment, is staff retention and the cost of staff retention. So, recruiters, or you have quite a key person in your business and they've moved on to a competitor or moved on to a different industry and stuff like that. So again, while salary is very important, the benefits to go with it are also very important again. So it's just something to think about as a medium-sized business owner,
And pensions will form part, like financial security and financial wellness is something that we've touched on in the session that was we had yesterday morning. And if people have said, evidence to show that if you're stressed about your finances, you're not going to be able to perform well in your role. And a pension, I guess, is one way of providing some sort of financial stability or security in the future, financial security for your staff. Getting a pension in place can really help
big time
make those decisions, especially for people the kind of maybe the 30s and 40s onwards age group, especially. They're thinking now about how they're going to fund their retirement. So if an employer is offering a pension, they're possibly likely to choose that if all else is equal in that,
exactly.
In that job offer.
The benefits now are nearly just as important as the remote working or the salary that comes with it. So people will compare the benefits, the pension or the life cover or whatever it may be that goes with it. And again, like people, just with the information age, there's so much out there now. People, and they talk to each other and say, what do you have? Or what people are just so much more engaged in the whole idea behind it that they now expect it as part of the package. Whereas if we went back maybe 10 years ago, there were certain industries or certain kind of larger corporations that might have had all the bells and whistles benefits, but people who had 5-10 staff, trying to build their business from the ground up found it difficult to get. And they're hearing it now from people who are turning down job offers and going, look, the benefits aren't up to scratch with what I have. You've given me a little bit extra in the salary, but it doesn't really equate or it doesn't justify the move, So people just expect it. That's just the way it is.
They expect a package, don't they?
Correct.
Some sort of benefit package, and that is part of it.
Absolutely, yeah.
And other options for employers, staying on that topic of staff benefits and attracting and retaining talent, you can offer life cover to your staff. So that means that their family will be protected if something should happen to them while they're working for you. There's also disability cover or income protection. So if they get sick, if they're ill or injured and they can't work, their income is protected. So their family and themselves are looked after. And that is you as an employee or employer looking after your employees and their family.
Big time. It's another part of the benefits that we touched on a couple of moments ago. The pension is just one element of it, but the life cover element, people might know it on their statements as death and service benefit and stuff like that. So typically it could be somewhere between 3 and 4 times the individual salary. So people value that benefits, and to get things like that on a kind of a group basis for 5, 10, 15, 20 people, generally not as expensive as some people or employers may think that it actually is, but the benefit you get out the other side of it with a staff member, God forbid, if something was to happen, one of them, or again, if one of them's out of work due to illness or injury for a lengthy period of time, something quite serious, but your sick pay entitlements in your job might only cover a month or two of salary, and after that, the mortgage, everything like that needs to be paid. So for something like that to kick in, even if it's for one person out of 20 or one person out of 200, it's quite powerful in terms of,
Yes.
you know,
You can see the story that someone can tell if
Correct.
they had that in place and they were able to keep going and their family didn't have to worry about the finances while they're also trying to recover
Exactly.
from some
Yeah.
illness as well.
Yeah, big time. Yeah. So it's so important. And again, it's really worth discussing. You know, every employer will have a budget, I suppose, of what they can afford to pay for these type of things. So sometimes it's trying to strike that balance when you're sitting with an advisor to go, look, I do want the life and the critical illness element or the income protection element, but I want to give a bit to pension as well. So
Yes.
try and balance what works kind of
Yeah.
for everybody and just build it over time then, you know, that's kind of the way to design it.
You can build a package that will suit.
Exactly.
And all of these offerings, these staff benefits are all tax deductible.
Correct,
So, you
yeah.
know, that they, again, coming back to that tax efficiency, it is a tax efficient way of giving a benefit to your staff.
Big time, yeah, absolutely, yeah.
Okay. I suppose we've just talked about protecting your staff as a way of protecting your business and retaining talent. But there are other ways that other things that I suppose business owners should be thinking about when it comes to protecting the business. So if you are working in a limited company as a director, you need to think about how the shares of your business are divided should something happen to one of those directors.
Yeah, exactly. So we touched on the point about, you know, protecting your employees and looking after their financial well-being, but there's also the other side of that is protecting the actual viability of a business. So for example, if you give an example of 4 directors running a company together, it could be 20, 10, 15, 20 staff and something like that. A lot of employers haven't sat down to discuss the opportunity or discuss the outcomes of what would happen if, God forbid, you know, say you have 4 directors and they own 25% of the company each, and one of them was to pass away. So 25% of the company will go to that individual's estate, a husband, a wife, children, whatever it may be. And not a lot of companies have asked themselves the question, God, what happens in that scenario? Does, you know, a wife or a husband now come in as a director and they're equal, you know, shareholding and equal like decision making in the business? And again, there's financial ways to, you know, protect something like that. Or again, the other side is you can protect a key individual in the business. So like we've seen certain instances where you might have 30, 40 people in a company, but like one person was the genius behind the product or the salesperson that has all the contacts and stuff like that. So again, it could be a very specialist industry where it might take a company 18 months to replace that individual if they were, God forbid, were to pass away. So between recruitment and business viability, like they can't just let the business just shut down overnight. But there's small, like inexpensive ways of making sure that, God forbid, something like that was to happen, that you have a plan in place of, you know, you have a little bit of agility in terms of how you can structure things going forward. And again, the awareness that's out there for those types of structures probably aren't out there as much as they probably should be. And again, if you are talking to the advisor about the pension or the staff benefits and stuff like that, ask about the business element of it, because there really is a couple of very clever ways to just protect yourself.
And affordable. And it is something that you're building your business, you're excited about maybe expanding it, and you're not thinking that's one aspect that you really need to think about. And it's an inexpensive and a tax deductible product option to protect you and your key
I suppose
members.
when people build their business, it could be themselves starting out, and then they might hire somebody, and then a family member, and then all of a sudden you might have a healthy business that's stable, 10 people working there, for example. You've put all the hard work into it over the years. It'd be a shame for something to happen, the viability of that business going forward, because you didn't have certain levels of protections in place. But again, you need to I suppose, build awareness about those type of structures that are out there, and just try and make your business that little bit more solid in the event that something goes wrong, you know?
Yeah, exactly. And coming back again to linking this with the maximising your pension and tax efficiencies there. For people who are starting out with pension funds that, you know, they've done the numbers with their financial advisor, they can see that their pension fund isn't going to provide the pot that they need right now, but it will take a number of years. But they also are aware that, you know, I need to protect my family should anything happen to me. There is an opportunity with that the death in service that you mentioned there, that life cover that for employees, a director can also use this as well, and they can maximise, they can really inflate the protection for themselves in order to fund a pension should they pass away. This will pass on to their family.
So it's kind of a bolt-on type addition that you would have in terms of the pension. So people at this stage, a lot of people should be familiar with the kind of tax reliefs that are available out there for pensions, and hopefully Pensions Awareness Week will make them even more aware of the different reliefs that are there. But there's a certain level of types of life cover a lot of people be familiar with. I took out a mortgage with my partner or husband or wife or whatever it may be, and the bank said we needed life cover, and then people will just kind of forget about that because a mortgage is a busy time for them, and they go, oh, I have some level of life cover, but it's only really protecting the loan on the house that they borrowed from the bank. But people aren't aware that within personal life covers umbrellas, there's also ones that are kind of under the pensions umbrella, and they can actually take out a bit of life cover for themselves and their dependents and get an actual tax relief on it as well, similar to the tax relief breaks that they're getting through the pension contribution. So again, you might have a budget of your 100 or 500 euros a month and stuff like that. Sometimes you could carve maybe 40, 50 euros out of that and get yourself a life cover element and still be paying into your pension at the same time. And again, God forbid something was to happen, both of those would pass to an estate for family, kids, and all that sort of stuff. So you've really, again, made things a little bit more solid in terms of an eventuality.
And for when you're like using it to bulk up your pension fund for your spouse, for example, if you passed away. Last year's finance bill changed some of the ways of how that was used. It used to just say it used to buy a pension for you. You pay your lump sum of 4 times the salary that they earned before they passed away, and then the rest of it had to buy a pension for life. So that spouse might be in their 50s, and they now have a pension that has to last until they're in their 70s or 80s.
Yeah. Which
wasn't great, but now that changed, and that means it now can be that balance of that pot of money can be reinvested in what we call an improved retirement fund.
Yeah.
It means it's reinvested, it's in your control. You can let it grow, draw money from it when you need to, but you can let it grow and build a bigger pot, I suppose, hopefully, when you actually need that pension.
Yeah, correct. Income. It's like an investment account on the side. So there might have been a certain element of the money that was a lump sum payout, typically 4 times your salary if it's kind of a company-based scheme. But you're right, the balance could have been 200, 300,000 or whatever was the insurance. And people would have said, I have to give that away now and only get a kind of a guaranteed pension for life. But now the recent changes last year to the finance bill, where people can actually take that sum of money, reinvest it, and then use it as the expenses, or taking money in and out and stuff like that, or invest it in low risk, medium risk, high risk way. It just gives again a little bit more flexibility for something that, with a good bit of financial planning at the outset, just makes everything a little bit more robust.
Yeah, and that it gives you back control.
Correct.
Which
financial
planning will help to achieve. So,
exactly.
So I suppose key messages for people listening today is. One, talk to your financial advisor. This is now the time of year. You're probably already talking to your accountant about your end of tax year return. So think about how you can maximise our tax relief on that income with a pension. Whatever protection options that you choose for you and your staff are also tax deductible, so don't forget that. If you are, say, in your 50s, you're thinking about succession of your business, start talking to a tax advisor now about the reliefs that you might be entitled to and how to plan for those reliefs to make sure you maximise those options. And finally, how to consider your financial plan. Auto-enrolment is coming in. If you're talking about financial benefits package for your staff, do consider a pension and other options that are tax deductible. But talk to a financial advisor. You'll be able to build a package that will suit your budget and will meet the needs, I suppose, of those staff as well, what the employees are expecting, and form something that will suit everyone in that
exactly package. Yeah, spot on, absolutely.
Very good.
Spot on.
Well, thank you everybody for tuning in, and I hope you gathered some tips from what we talked about today. The Pensions Awareness Week continues all the way to the end of this week, and so there will be more topics we'll be discussing. What to do with your pension plan if you're midway through your retirement journey and you want to keep that on track. We're also talking about how to act before you get to retirement when it's coming close, what you should be thinking about. And we will finalise the week with some summary of all the topics we discussed so far. So hopefully there's something in there for everyone, and you'll get some good tips, good advice, and log on to the website, pensionsawarenessweek.ie, and you'll find links to all the other sessions and playbacks as well. And thank you very much, and have a good day.